In late January 2026, two people in Atlanta, Georgia were sitting on the same investment. Both of them had bought gold. Both of them had watched it do something extraordinary, climbing from $2,600 per ounce at the start of 2025 to $5,589.38 per ounce on January 28, 2026, 53 new all-time highs in a single calendar year. A 60% return in 12 months, the best annual performance gold had delivered in over 4 decades. The World Gold Council reported total gold demand in 2025 exceeded 5,000 tons for the first time in history, generating an unprecedented $555 billion in annual value, 45% higher than the year before. Everyone who had bought gold early felt like they had finally gotten something right. Then, the Middle East erupted. Iran threatened to close the Strait of Hormuz. Oil surged, and gold, which everyone expected to spike on the geopolitical news, did something that confused and then terrified most of the people holding it. It fell. Hard. By late March 2026, gold was trading near $4,300 per ounce, a 23% decline from its January high. Gold futures fell 13.54% between March 3rd and March 31st, the worst monthly performance since October 2008. Silver had dropped even faster, falling more than 8% in a single session on March 3rd, in what analysts described at the time as a mechanical liquidation event. The DXY dollar index had climbed from approximately 99 to 106. The 10-year Treasury yield had risen from 3.97% on February 27th to 4.44% by March 27th. The Fed had signaled it was pricing out rate cuts for the rest of 2026 entirely. Michael Tran was 47 years old, electrical contractor in Atlanta. He had watched gold's 2025 run with growing anxiety that he was missing something historic. In October 2025, he moved $40,000 into a GLD ETF position, buying at approximately $4,000 per ounce. By January 28th, he was up nearly 40% on paper, a $16,000 gain in 3 months. Then March arrived. By March 25th, his $40,000 had fallen back to approximately $34,300. He was still technically in profit, but watching gains evaporate daily, reading headlines about gold's worst month since 2008, and feeling something he had never expected to feel about gold: doubt. He sold on March 26th at $4,380 per ounce. He had entered at $4,000, he exited at $4,380, a small nominal gain. He felt relieved. He told his wife the trade had worked out. He moved the money into a money market account paying 4% and stopped thinking about gold entirely. Catherine Osei was 52 years old, retired school principal in the same city. She had first bought gold in 2022 when it was trading around $1,800 per ounce. She had added to her position throughout 2024 at an average cost basis of approximately $2,400 per ounce. By January 2026, she was sitting on over 130% in unrealized gains on her full position. When March's crash arrived, she did not sell. She did not even open her brokerage app for 2 weeks. She had seen this pattern before. Not in her own personal experience, but in the data she had spent 3 years systematically studying about what gold does in the weeks and months after an oil shock. She understood the mechanism. And the mechanism told her that what was happening in March 2026 was not gold breaking down permanently. It was gold doing precisely what it always does at this exact point in a 50-year repeating sequence. Step 3 of 6, Phase 1 of 4. Completely predictable to anyone who had read the history. Same asset, same crash, same March 2026. Michael sold into Phase 1 panic, locked in a small nominal gain, and walked away from a position that the 50-year documented record suggests was entering its most powerful phase. Catherine held because she understood what Phase 1 is, what has always followed it across 5 prior cycles, and why the very conditions that caused the crash, the dollar surge, the yield spike, the leveraged liquidation, are the same conditions that have historically ignited the largest sustained gold and silver advances in the modern data record. My name is Ban, and I spend way too much time going through 50 years of oil shock data, Federal Reserve policy records, DXY index charts, gold and silver price histories, and the documented behavior of institutional gold investors who built the largest precious metals fortunes in history. Not by picking the perfect entry price, but by understanding a specific 6-step mechanical sequence that has run in the same order every single time an oil shock has hit the global economy since the gold standard ended in 1971. What happened to gold in March 2026 is not new. It is not confusing. It is not a signal that gold is broken or that the bull market is over. It is step 3 of a sequence that has a documented next step. And that next step is what every gold and silver holder watching this right now needs to understand clearly before they make the same decision Michael Tran made on March 26th. If your position is red right now, or you sold during the crash and you are wondering what you actually did, stay with me, because Phase 1 is not the end of this story. In the 50-year record, Phase 1 is where the story begins. The sequence has a name. I call it the oil shock transmission mechanism. It has 6 steps. It ran in the same order in 1973, in 1979, in 1990, in 2008, and in 2022. And it ran again in March 2026 with mechanical precision. Step 1. An oil shock hits. A supply disruption, geopolitical event, or production cut produces a sudden spike in the price of crude oil. In March 2026, it was Iran threatening the Strait of Hormuz, the choke point through which approximately 20% of the world's daily oil supply transits. Brent crude surged, the energy market repriced dramatically in days. Step 2. The dollar surges. This is the mechanism most gold holders miss entirely. When an oil shock hits, global markets immediately increase demand for US dollars. Because oil is denominated in dollars globally, every country that now needs to buy more expensive oil needs more dollars to do it. Simultaneously, in any geopolitical crisis, the dollar attracts safe haven capital flows from around the world. The DXY dollar index climbed from approximately 99 to 106 during March 2026. A 7-point move in a single month is historically significant. Step 3. Gold falls. This is the step that generates confusion, panic, and premature selling. Gold is priced in dollars. When the dollar strengthens sharply, gold expressed in dollar terms falls, even if its real purchasing power is unchanged or increasing. Additionally, leveraged traders who hold simultaneous long positions in both gold and oil face margin calls as volatility spikes across both markets. They sell gold not because they have concluded gold is a bad investment, but because gold is highly liquid and they need cash immediately to meet margin requirements. The March 2026 analysis confirmed this precisely. Gold initially spiked from $5,296 to $5,423 on the Hormuz News, then reversed hard, down more than 6% from the intraday high, as paper traders flushed their leveraged positions. Meanwhile, physical gold premiums stayed elevated throughout. Demand from central banks, jewelers, and long-term institutional buyers held steady. The physical market and the paper futures market were telling completely opposite stories to anyone willing to look at both. Step 4. Real yields spike. The oil shock changes inflation expectations in a specific way that tightens financial conditions for gold holders. If oil is rising, inflation will be more persistent. If inflation is more persistent, the Federal Reserve cannot cut rates. If the Fed cannot cut rates, real yields, the return available on Treasury bonds after adjusting for inflation, rise. When real yields rise, the opportunity cost of holding gold, which generates no interest or dividends, increases relative to government bonds. The 10-year real yield climbed from 1.72% on February 27th to 2.13% by March 27th. That 0.4 of a percentage point move in real yields drove more institutional gold selling than any war headline. This is the mechanism, not the emotion, the arithmetic. Step 5. Recession fears build. This is the turning point that most people miss entirely because it develops slowly while steps 3 and 4 are still dominating the narrative. An oil shock is simultaneously inflationary and recessionary. It pushes prices higher while destroying consumer purchasing power, compressing business margins, and slowing economic activity. The Federal Reserve faces an impossible choice: raise rates to fight inflation and trigger a recession, or cut rates to support growth and allow inflation to remain elevated. Every oil shock in the last 50 years has resolved in the same direction. The Fed eventually pivots toward protecting growth. Real yields fall, the dollar weakens, and gold moves into Phase 3. Now, here is what the historical record shows about what Phase 3 and Phase 4 actually look like in numbers.
Phase 1 is the confusion phase. Oil shock, gold falls, retail holders panic and sell. Headlines describe gold's failure to perform as a safe haven. This phase typically lasts 6 to 12 weeks. It ends when the dollar peaks and real yields peak. We are leaving Phase 1 right now. Phase 2 is the accumulation phase. The dollar and yields stabilize near their peaks. Smart money, institutional investors, central banks, family offices with the historical context to recognize the pattern, quietly builds positions at Phase 1 prices. The World Gold Council confirmed central bank gold purchases are running at 585 tons per quarter in 2026 throughout this entire correction. China's People's Bank of China extended its gold purchases for the 15th consecutive month in January 2026, buying at record prices, and showed no sign of stopping through March. Central banks do not panic sell gold. They accumulate it through Phase 1 and Phase 2 because they have institutional memory of what Phase 3 produces. Stay with me because this is the critical part. Phase 3 is the dollar reversal. The DXY peaks and begins a sustained decline. Real yields compress as the Fed shifts from hawkish hold to easing. Gold recovers its Phase 1 losses and then advances beyond its pre-shock levels into new territory. The World Gold Council's own February 2026 commentary stated directly that the DXY's downward trend is likely to resume after the short-term crisis-driven bounce, and described this resumption as a key positive force for gold prices going forward. This was published by the gold market's own research authority while gold was in free fall. They were not panicking, they were reading the mechanism. Phase 4 is the real asset revaluation phase. Gold advances substantially. Silver, which has both monetary and industrial demand and trades in a smaller, more volatile market, typically outperforms gold in percentage terms during this phase. The gold-to-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, is historically an extremely precise Phase 4 signal. The long-term average is approximately 60 to 1. At crisis peaks, it has reached as high as 120 to 1. In 1979 to 1980, when the ratio was at extreme levels entering Phase 3, silver moved from $6 per ounce to $50 per ounce, a 733% gain, while gold moved from $250 to $850, a 240% gain. Phase 4 compressed the ratio violently as silver caught up and then dramatically overshot. The gold-to-silver ratio entering April 2026 sits above 80. That is not the average. That is crisis territory. Phase 4 historically resolves it. Now, let me walk through the historical record precisely because these are not projections. These are prices that already happened. In 1973, Nixon had ended the gold standard in August 1971. Gold was fixed at $35 per ounce. The Arab oil embargo triggered Step 1 through Step 6 of the mechanism. Gold initially fell as the dollar surged on energy-driven dollar demand. Then the mechanism completed. By December 1974, gold reached $195 per ounce, a 457% gain from the pre-float price over 3 years. The oil shock that appeared to damage gold was the ignition of gold's first great modern bull market.
In 1979, the Iranian Revolution disrupted global oil supply. Gold was at approximately $250 per ounce in January of that year. The oil shock triggered the mechanism. The dollar surged, gold initially stalled. Then steps 5 and 6 arrived as recession fears mounted and the Fed eventually shifted. By January 1980, gold hit $850, a 240% gain in 12 months. Silver went from $6 to $50 in the same period. The mechanism completed exactly. In 2008, Lehman Brothers failed in September. Gold initially fell from $900 to $740 as the dollar surged on safe haven demand and leveraged traders faced massive margin calls. Identical mechanical dynamics to March 2026. By February 2009, gold was back above $1,000. By September 2011, it reached $1,920, 159% above the Phase 1 crisis low for those who held or added through the confusion. In 2022, Russia invaded Ukraine. Oil surged. Gold fell from $1,974 to $1,620 as dollar strength and rising real yields compressed the price. Step 3 and 4 of the mechanism running precisely. By the end of 2025, gold had reached $4,550. The Phase 1 sellers in 2022 missed the entire move that made 2025 historic. The pattern is not a theory. It is a 50-year documented record across 5 separate oil shock events. Oil shock, dollar surge, gold falls, yield spike, recession fears build, dollar weakens, gold explodes. Every time, without exception. 2 numbers to watch instead of war headlines. DXY below 97. When the dollar index falls back below 97 after a crisis peak above 100, that is the Phase 2 to Phase 3 transition signal in the historical record. The DXY peaked near 106 in late March 2026. It was already retreating toward 100 by early April as Middle East diplomacy showed tentative progress and soft U.S. economic data reduced the dollar's safe haven premium. Track DXY daily at any financial site for free. When it crosses below 97, Phase 3 is in motion. 10-year Treasury yield below 3.5%. When the nominal 10-year yield falls below 3.5%, real yields are compressing and the opportunity cost arithmetic for gold collapses. The 10-year peaked at 4.44% on March 27th and was already retreating toward 3.85% by mid-April as 3 rate cuts were being priced back into market expectations following soft retail sales data and cooling employment signals. 3.5% is the line. When both DXY and the 10-year confirm simultaneously, Phase 3 is fully active. For instruments, GLD for gold, SLV with its higher Phase 4 beta, and AAU, the Perth Mint Physical Gold ETF for physical gold held outside the U.S. banking system in an Australian government vault for those who want zero institutional counterparty risk. Let me bring this back to where we started. Michael Tran sold at $4,380 on March 26, 2026. He had entered at $4,000, a small gain. He moved the money to a money market fund. He told his wife the trade worked out. And in the narrow sense of having more dollars than he started with, he was correct. But he sold out of a position mid-mechanism at step 3 of 6, the same step at which retail holders sold in 1973, in 1979, in 2008, and in 2022. Every single time, the people who sold at step 3 watched from the outside as steps 5 and 6 ran without them, and phase 3 produced the gains they had originally bought gold to capture. Catherine Ossie is still holding. Her average cost basis of $2,400 means that even after the 23% crash from the January high, she holds approximately an 80% gain. She is not watching the daily price. She is watching DXY and the 10-year yield. She has seen both numbers move in the direction phase 3 historically requires. She knows JP Morgan's 2026 gold target of $6,300 per ounce was set before the Iran escalation made the underlying conditions more extreme than the analysts assumed when they set it. She knows that what made 2025 extraordinary, 60% annual returns, 53 all-time highs, the first-year gold demand exceeded 5,000 tons, was Phase 3 and Phase 4 of the 2022 oil shock mechanism, completing over 3 years. And she knows the March 2026 oil shock just started the clock on the next cycle. Same asset, same crash. Michael saw a falling price and a frightening headline and made a rational decision, without the framework. Catherine saw step 3 of a 6-step mechanism she had spent 3 years learning to read and made an informed decision with it. The mechanism does not care about war or headlines or which politician is speaking. It runs on the same macroeconomic arithmetic every time. Oil shocks create dollar demand. Dollar demand suppresses gold. Recession fears force Fed pivots. Fed pivots weaken the dollar. Weak dollar releases gold. Watch DXY. Watch the 10-year. When both numbers confirm, you will know exactly what phase you are in. This is Ban. Stay sharp out there.